Hello everyone, I just wanted to give you some information on Chapter 2 on T accounts and financial statements. I started to look at some of the homework assignments from Unit 2, and I just wanted to brush up on a couple things so that you understand what T accounts are, how we use them, and the financial statements. So basically, our T accounts, because they look like a T, represent each of those accounts that fall under our categories: assets, liabilities, capital, draw, revenue, and expenses. All of these you have been working with so far and understand what falls under those. Now, instead of the plus and minuses within that expanded accounting equation, we're going to start looking at a T account and which side increases and what side decreases. And if you look here, we know that our assets will increase on the left side and our assets will decrease on the right side. Liabilities, they'll decrease on the left side, increase on the right side. Our capital will decrease on the left, increase on the right. And our draw will increase on the left, decrease on the right. Our revenue will decrease on the left, increase on the right, and our expenses will increase on the left and decrease on the right. So that being said, I do want you to start to move away from plus and minuses, and I want you to use debits and credits to identify which side of the T account you're talking about. So our debit is going to mean that it's the left side of our T account, and our abbreviation is DR. The credit is the right side of our T account, and it is abbreviated CR. But be careful about the fact that you're not using or thinking that credit always means minus, because that's not true. We could have an account that has a positive number, but yet it just sits on the credit side because based on our accounting equation, it must be in balance. So this is the way that we do that now. So here is just a synopsis of which accounts increase and decrease. So my debit is going to signify an increase in my assets, draw, and expenses, a decrease in my liabilities, capital, and revenue. My credit is going to signify that my decrease will occur in my assets, draw, and expenses, and it will increase in my liabilities, capital, and revenue. It's important that you understand the debit and credit rule, that my debits must always equal my credit. And when I talk about an entry or an economic event, at least one debit and at least one credit is involved. For every debit, I must have a corresponding credit. So you must keep that in mind, that must always equal. My T account here is just a basic example of the T account. You can see that on the debit side, we are increasing it. On the credit side, we're decreasing it. And what we'll do is we will add these columns up. So I added the debit side, A, F, Q, and R, and got my total, and I wrote it there, as well as my credit side. So now I need to know what my balance is, because I know what my debits are and what my credits are, but now what's my total balance? So this process, by the way, is called footing. So I know that my balance is $55,890. And the rule is that we put the balance on the normal side, which is the side that that account increases on. Again, my normal balance is going to end up on the side of my T account that it increases on. That is the typical placement, unless we would overdraw our cash account, but typically there's other means in place for that, and that's a different kind of transaction and a different kind of class. So again, just our T account form. This is a footing. We double underline when we've got our balance, because that indicates that that is the final number. Here is how a transaction would flow through the T accounts. For this example, the owner invested The owner adventures bought equipment paying cash of $38,000. So as you can see, I am going to debit my equipment because I'm increasing my assets, so it's going to occur on the debit side. And I used cash, so my cash is going to decrease, and that will happen on the credit side. Again, you guys should all start to think that this is called shifting. I've just shifted my assets. My assets still will total the same amount, I just have a different structure. For this example, they bought equipment on account for $4,320. Okay, same concept. I'm increasing my equipment, so it's going to go on the debit side. Now I've incurred a liability because I'm going to pay my vendor at some point in the future. So now I'm going to increase my accounts payable, and that will happen on the credit side. I have a debit and a credit, and they're in balance. So this one, we're going to pay our creditor. So now I'm going to debit my accounts payable because it's going to decrease. I no longer owe that much to that vendor. And I used cash, so now I have to decrease my cash on the credit side because I have $2,000 less in cash. We invest personal computer, fair market value was $5,200. So I'm going to debit equipment, again, because I'm increasing the amount of equipment I have. And she invested it, so it's an additional capital investment. So her capital is going to increase by that $5,200. This is what we call a summary of our transactions. Every T account that was impacted by our journal entries or our transactions are listed. They're all footed, so that way we know where our balances are. The problem is that we need to make sure that our debits and credits do equal. So we can run through this little thing here, or we'll do a trial balance, which we'll get to in another slide. But this is the to ensure that our debits and credits do in fact equal. Another way to remember this debit credit is that you could use a cute little saying, all drippy eels love cucumbers and radishes, starting with assets, draw, expense, liabilities, capital, and revenue. I typically say try to remember one on each side. That way you can always kind of back into your transaction. I hope this helped to offer some insight in T accounts. The next video will be on the financial statements.